Good morning, everyone. Let's get seated. I know it was a late night last night, and many of you are wondering whether singing abilities are correlated to risk management understanding and capabilities. I think many of us would like to think so. But thanks everyone for participating in a long day yesterday. It was a great day for Metric Stream, and look forward to today. So I'm Brenda Boltwood, and I'm a Senior Vice President with Metric Stream, part of our leadership team, and work with our large customers globally. I, before joining Metric Stream, was a customer when I was the Chief Risk Officer of Constellation Energy. And after the financial crisis, we're looking at the board's request for a better way of bringing two things. One was, a consistent language about the risks we were facing and how those risks were rated. The board was just fed up with IT saying this was the biggest issue, audit said something else was the biggest issue, risk said something else. And it may have been they were related, but we used different languages, and the board really got whiplash trying to figure out what we were trying to say and interpret it, right? So can we get on a common language? Can we agree if it's red in IT, it's red in audit, it's red in risk management? And then the other thing was after the financial crisis, the company was downsizing. So we had to look to streamline our kind of corporate infrastructure costs, right? And when every silo was operating with its own systems and infrastructure to support its risk reporting, it got expensive, not just in terms of the maintenance and licensing fees, but all the people required for support. So we saw significant reductions as we introduced, a single GRC platform. And yeah, that was Metric Stream at the time. Before that, though, I was at JP Morgan, where I headed up risk management in one of the lines of business and led a business called Global Derivative Services. Before that, I headed up market risk, counterparty credit, and operational risk at Bank One. And then, other risk jobs before that. So 25 years really in risk and compliance. But where did the time go? So, when I started doing risk management, it was a little bit after this film was released. But what's interesting is to be standing here today talking about enterprise risk management. And, when I started my career, all banks really did, financial institutions, was manage credit risk. Right? Market risk was new. The idea that you could look at transactions, you could aggregate them at a portfolio level, and then you could have summary metrics like value at risk or deltas and gammas and betas and thetas to measure rates of change in those portfolios, right? And sensitivities to different variables. But things have evolved, and regulators have also gotten more proactive in risk management, and so we've seen more guidance around not just market and credit risk, but also operational risk. And where is all this going? So we're going to call this kind of the return of ERM, and it's going to be in a slightly new form. And it's going to extend beyond its current scope, or its old scope, really, its past scope. And what's different today, and this is going to be my punchline at the end of the presentation, because we're going to talk about the fact that a lot has changed since the 80s, right? And today we can say confidently that the technology exists, right, to integrate risks across qualitative and quantitative risk measures, right? The technology exists. Platforms are scalable. They can be managed to get to the performance levels that you're looking for. I think very importantly, the data model exists. We can manage these risks, but we can relate the output of our risk management efforts through a data model. And then, we're seeing increasingly across companies that performance incentives are being aligned with our ability to execute, right, along this line of enterprise risk management or extended ERM. And then, importantly, the idea is maybe we can get something out of this, right? So we can scale and scope, we can create a flexible data model, we can identify risk data through our taxonomies, and we can mine our risk data. So, we're getting to the point now, and you've heard it in the discussions on Monday and Tuesday, where we're thinking about artificial intelligence, we're thinking about predictive analytics, and it's not just an idea, we're actually implementing and executing at many places this idea so that we can build not just reporting in a silo of operational risk or third-party risk management or audit or market risk or credit risk, but across these risk disciplines, applying these new types of analytic techniques. And what are companies looking for? Talking to one major bank in New York, they've just set up a new enterprise risk management program. It was kind of a reprise from something they were doing before the year 2003. But what's different today is they're looking to bring these different sources of risk information together, apply advanced analytics so that, if the idea of a blue van is mentioned in one risk assessment and it pops up in another risk assessment, it pops up in an issue, they can then have the machine bring that intelligence together to try to find something that may be emerging that no one in their silos might necessarily recognize. But when you're bringing this data together across the qualitative and quantitative risk information, you're able to detect new information and ways of viewing what's important to the company overall. So very exciting stuff. And it's not just one or two companies. We're really seeing, kind of a pickup of these enterprise risk management ideas. And, what's different? Well, we have to extend the scope of risk management because the business model's changing. And we heard yesterday a panel of board members talk about, when they're asked the question, what's the most important risk you face? Is it cybersecurity? Is it, your operation and execution risks? Is it your credit risk? He said, well, it's all of it, right? It's coming from all directions at us, right? And so we've got to be aware that, we're going beyond traditional products. We talked yesterday about how consumer behavior, buying patterns are changing, how we interact with customers, more and more digital, right? We have shorter customer attention spans. Gunjan Sinha talked about how we need it now. Right? We need that information now. We need to feel that accomplishment of that transaction. And so all of this has led to not necessarily new risks, but the need to look at these risks together. We can't necessarily look at cybersecurity risks and say, oh, I feel comfortable with all our mitigation plans because you know what? That next strategic risk, as Chris McLean was talking about from Forrester, we may just spend 5% of our time discussing those strategic risks, but when we have risk events and we attribute it to a type of risk, it's the risk that's costing us, overall about 80%, 85% of, kind of the total cost of risk incidents across our company. So in summary, it's not about necessarily, that the Jedi is back, right? But because we have this unique situation where we have all of these risks coming together, and now we have the technology, we have the data model, we have the enablers. So you say, what could go wrong, right? If we're headed in this direction, what could be the obstacles? You know what? And it's the soft stuff we're seeing, right? It's the ability to bring the collaboration, from across the silos, and it's the ability to execute large programs. But we know from our discussions yesterday and on Monday that many companies are getting through these challenges, right? Setting up very successful program management capabilities and, bringing together this information. So the scale of enterprise risk management is growing, and, going, not to talk too much about history again, but, it used to be that we were talking about impact and likelihood. We learned that from our market risk days, right? We applied that to market and credit risk. We now apply it to our risk factors as we try to understand the relative importance of our inherent risks, right, across the qualitative information that we're looking at. But now we're confronted with also the velocity of change, which we say is happening quickly. And as we just highlighted, the interrelationships between these risk types, and the fact that, getting your arms around cybersecurity risk is not adequate because you have the next strategic risk coming at you from the side, right? So what this is about is at large financial institutions, large companies globally, we've set up very mature risk management functions, but they typically exist in silos, right? So we still have our market risk, our credit risk, our operational risk, our third-party risk, our BCM, our compliance risk assessments, our legal and general counsel risk assessments, dealing with third parties. But we really are still talking about the need to bring this integration together. Okay, so that has been the essence of a governance, risk, and compliance program, right? But in governance, risk, and compliance, we've really been focused on those qualitative risk management capabilities, right? What we learned from market and credit, and bringing qualitative capabilities to, the softer risk management functions like operational risk or third-party risk. But the lack of information in an integrated sense is leading to regulatory challenges, right? And many of you are aware of some new Basel guidance that came out in the form of BCBS 239, right? And so this need for an integrated data model meant all of you guys are here, you get it, you're part of the solution. But regulators still felt that we weren't moving fast enough, and we needed to ensure we had complete data models, right? That these data models were accurate. So we have data quality oversight, right? And then also we have the ability to adapt these data models through change controls over time, right? So here again, we're talking about our organization structure, our risk taxonomy, our control library, and that adaptation, the management of the relationships between these data objects, it's got to be timely, and it's got to have data integrity, right? So how many of you here have worked with BCBS 239? Have you heard of it, right? It's a regulatory kind of bulletin that's out there from Basel. The expectation is that there'll be regulators, requiring adoption over time, and different regulators, whether it's the Fed or the OCC or the PRA, are setting their timeline. But for the first time, they're looking underneath the types of risk information we're managing and saying, how is that data model being managed so that we can get to the aggregation of risk information that we need, and the reporting, the accurate and timely reporting of that information. So here you have a regulatory requirement all around aggregation and reporting, right, across the risk types. And again, I look at this and I think it's a lot like what's happened in operational risk as the regulators have moved from kind of what we've called, kind of advanced modeling capabilities and allowing different financial institutions to create their own bespoke capital models. They said, oh my goodness, many of you probably have done a great job, but it's very difficult for us to understand how to compare these capital models and how to, determine whether one's better than the other. So they recently changed, from an AMA approach to the standardized measurement approach, SMA, right, which is more prescriptive. And it's driven by a combination of internal information as well as external factors, and is going to be consistent across all the banks that do the reporting. Okay, so this BCBS 239 is something similar, but gets to the underlying data model itself. Okay, so with that as a driver, we can say, oh my goodness, we've got to now think about that data model, but the information in our company is everywhere, right? We have the risk guys, and this isn't just an operational risk now, it's market and credit risk, it's vendor risk management, it's compliance risk management, it's a broader set of third-party risk management, but we're going to bring that information together with a common taxonomy, and we're going to marry it to our business universe, so how we map it to our organization, our processes, our products, our assets, and our functions. And then, we're going to have to link that to what we've created in our compliance world, right, in terms of that inventory of compliance requirements, not just BCBS 239, but the plethora of other requirements that we have, and where we manage areas of compliance, the names of all our regulators, the types of engagements we have, and the change in those things. And then, that third line of defense on the audit side, creating the findings, the auditable entities, and the evidence. So how is all this going to be brought together in an organization structure that's not just, kind of business unit and functional unit, but, we need to manage that information by region and country, and then also by legal entity, right? So, if we focus on the risk universe, we know we've got BCBS 239 now coming down from the regulators, which is all about, that data model, the completeness of that information. But we've also got a risk framework, a risk library, as we've talked about, that, is covering those, kind of the second line of defense. If you look at what's in the blue there, that's operational risk, it's IT risk, it's third-party risk, business continuity risk, compliance risks, right? And we've talked about kind of an integrated second line of defense, right? And our ability to share information, share, the controls, the control environment, and the control testing and assessments. But now at the bottom, we've got those quantitative risk measures. So we've got market risk, credit risk, liquidity risk. And then we talked yesterday in some of our panels about the importance of these longer range risk management functions around, what are the strategic risks, or what could really impact the company and our assumptions about our business model in that 3 to 5 year time frame. Okay, so we've got lots of different risks. So we've got a federated risk taxonomy, and we've got this capability, or this need now from the regulators in BCBS 239 to be managing the accuracy, completeness, integrity, as well as the adaptation of that data model over time, right, with all of its relationships. Right? Those are that's been the special sauce of GRC, is saying it's not just good enough to manage in silos, but we're going to find the relationships between this risk information as well. And we're going to manage that in a, risk control data model, right, that builds off of the types of risk assessments we perform, whether it's a vendor risk assessment, an operational risk assessment based on, kind of a look at a process or a business unit that we're managing, the control tests for those controls related to the risks we're managing, the scenario analysis, the metrics that we're managing, the issues that are being created, not just by audit, but any group performing risk assessments, whether it's compliance or IT or the third-party group. And we're managing incidents, loss events, near misses, right? And relating all that information to each other, and then to that data library, right? That risk taxonomy that we've worked so hard to create, right? So it's all of a sudden, it's starting to look, just even on the risk side, look at that picture, right? It's getting a little complicated over here. But this is, proudly, I think we can say this is what we've developed, right, around qualitative risk management. And now the next step we're taking is, that it's really about integrating across all these risk types, and including the quantitative measures like liquidity risk and market risk, right? But that's just a piece of the story, right? So we have these risks that we're managing. We've got a federated kind of risk taxonomy. We have all the types of information used to glean intelligence from that qualitative type of information around operational risks. But now we've got to relate it back to our organization. Where does this have impact? Which business unit? Which legal entity? We need to be able to slice the data by country, by region, by function, by asset, by product, by process, right? So that we can use that same data model to allow different types of storytelling, right? Different types of analysis across the organization, right? So that it serves multiple needs, right? And so our enterprise risk management landscape now is looking a little like a ball of spaghetti string, but we know we've got a structured risk taxonomy. We know we've got data integrity checks around that data model. And then we've got structured processes for managing all those metrics and performing our risk assessments, managing the scenario analysis, and so on. But we have to add the compliance piece, and then we add the audit piece, right? And this, right, becomes our enterprise risk management framework, extended to include not just the qualitative risk that we've been managing kind of under the broad operational risk umbrella, but also those third-party risks, the compliance risks, and now the qualitative, and all of this aligned between, kind of an integrated second line of defense in terms of the data model, but also with the third line of defense. But what's been one of the most important topics we've discussed is that all of this serves the first line of defense, right? And becomes the most relevant, a very relevant source of information, in our view, that drives every staff meeting of every business person. What else should they be talking about but their most important risks and issues? What came out of the last risk assessment? What is the scenario analysis saying? But to do that, we've got to have relevant information and quick, right? They want it now. Okay? So now that we have that high quality data, we know the business wants it now, right? Where does it come from, right? Or what do we do next? And all of us, I think we've all sweated through the process of getting to this point. Now, where is it going? Okay? And by the way, I just wanted to say I'm blinded a little bit by the light here, but we'll be looking for hands, and feel free to ask a question at any time. And I've got some colleagues here with microphones, so I'll be looking out, but would love to hear your questions and thoughts as we go through this. So what's happening next? Oh, okay, so we have this whole phenomenon now of big data, right? It's not just the structured information we've been managing through our risk taxonomies and in performing our risk assessments, but we've got information coming, as we say, from external sources. And this could be structured content coming from professional content providers, groups like, the guys from UCF that are standing next door, trying to bring us a unified controls framework, across NIST, COBIT, ITEL, COSO, and ISO and other standards, right? How can we harmonize that information? We have Dow Jones sending us alerts, about our third parties, right? But also helping us with our OFAC and PEP screening, right? And we have others providing information about changes in regulations, right? But we also have the need to connect into email sources of information, also RSS feeds that may be relevant to the people performing risk assessments or managing information. And so we've got to bring that big data into this equation, right? Through structured business rules or phrases that we're looking for, so we can intelligently direct that information to the people that need it in the second line of defense as they challenge risk assessments, but most importantly to those in the first line of defense, so that they don't get blinded by the organizational walls, right? They are able to look at the broader environment in their industry and their country and bring that information to bear as they're thinking about the risks that are relevant. So this affects, not just operational risk, but also, the ability to manage changing compliance requirements, the ability to adequately onboard and monitor our third parties, right? And then in our audit, the ability for auditors to, see that information, not just from the internal sources that we've structured, but also contextual information coming from outside to better inform, everything from how you plan and scope an audit to how it's executed and which controls are most important for testing. But, basically leveraging this integrated platform to bring us better competitive intelligence, right? Okay, so now we've talked a lot about structured data. We've talked about regulatory requirements, BCBS 239, and the requirements to have, real integrity around that data model and the ability to aggregate and report information. Now we've added big data, right, to this equation and bringing contextual information from external sources, as well as unstructured internal sources like emails or memos and policies, right, that you're operating to. So that information can be relevant to the people. Performing risk assessments, overseeing and challenging those risk assessments, and then providing assurance. And so we've been talking about the notion of, collaborating across the lines of defense. But now, again, just to repeat, we have the technology, we have the data model, we have the different sources of risk information, whether it's qualitative from more the operational risk management side, or whether it's quantitative and you're measuring liquidity and market risks, right? And now the risk functions, the business groups, the audit functions, they're doing things with this data, right? So the business is using this data to formulate its business strategy, right? Linking to its business objectives. We've talked a lot about risk appetite, setting up a risk tolerance, right, level. And then, working to ensure that we've got kind of a common naming convention across our risk universe, operational compliance, third-party IT, market, credit, and so on. And then we've got the second line of defense actually doing their work. And in operational risk, we call it RCSAs, capturing metrics, capturing risk events, and then doing scenario analysis. And then in third-party management, we've got vendor onboarding, in terms of the risk assessments we're doing. Are they an appropriate third party to bring in? And then the ongoing monitoring. Can we capture their contractual SLAs? Can we monitor those SLAs over time against information that's coming in real time, not just from that company, but relative to their tiered peer group in the third party management space, and then manage the risks and losses that come to us from those third parties. And then the whole compliance element, regulatory, your rules inventory, your changes, and then your compliance risk assessment, and then the ability to map all of your rules to compliance policies, to controls, and to the business units, right, that are subject to them. So a lot going on in this collaborative notion of, integrating across the lines of defense, first, second, and third. But we're seeing this is happening in many organizations and leading to, much more integrated, second line of defense functions and a third line of defense that's able to leverage the information from the first and second line of defense. Okay, so what's an example? How does this look in reality? Well, if you just look at third-party risk management and enterprise risk management, right, or operational risk management, on the right-hand side in the blue, we're managing risk metrics, risk assessments, risk events, loss events, scenario analysis, and then culminating in issues and actions that are managed, right? But in the third-party area, we know that we've got contracts that we're monitoring with third parties, making sure that they're compliant with the rules that we've set out for that relationship. We're performing risk assessments. We're putting together mitigation plans that our third parties are responsible for adhering to. We're doing due diligence and continuous monitoring of that third party through its life in the organization, and we're managing performance, like which third parties are actually doing what they said in their contract and which ones are performing best across the tier of vendors in a certain category or, at a certain spend level, within the company. How can that does it make sense to share that information? Of course it does, right? And so, kind of the natural kind of arrows going back and forth in terms of, incorporating issues that have been identified in the operational risk assessments, related to a business process that third party supports, right? And when you can do that, you say, well, how else could we really assess risks in a business process, unless we were able to include, the issues and action plans, right, that are being managed by our third-party group and in conjunction with the vendors we use. We're doing that due diligence and monitoring. So any kind of risk event, it needs to not only be known by the third-party team and the vendor, and perhaps priced into the quality, right, that they're providing our company, but also managed as a loss event by the operational risk management team. And then, performing those risk assessments in the operational risk area against a business process or a business unit. But because we now have a data model that ties those third parties and vendors to that business process, able to see the types of third-party risk assessments that have happened so that information can be brought into the overall operational risk assessment. And then looking at contract compliance, we're monitoring SLAs. Many vendors are sending us that metric information, but now lining it up against those third parties, which are lined up against the process, and using those metrics to bring intelligence for our continuous monitoring program to indicate not just the level of residual risk we found in our last quarterly assessment, but how is that risk level changing as the metrics coming in are evolving over time. So questions about this? Because the interesting thing is, this is just one example, but we could lay all the functions against each other, right? So we could, instead of in the top left corner it being third-party risk management, it could be IT risk assessments, right? And then it could also be compliance risk assessments, and it could be compliance versus third parties, or operational risk versus the compliance risks, and operational risks against the IT risks, right? But we're realizing they're all related, and the information from one area needs to feed the other to get the really holistic view of what's going on, not just from an operational risk perspective, but from a compliance management, a third-party management, and an IT asset risk assessment perspective. Any questions or comments, right? But we're showing this collaboration, based on the output of information. So we have, kind of this notion now that we've created around enterprise risk management. But just to kind of refrain some of the principles we've talked about, Gunjan set them out in his keynote about, this is really all now about the first line of defense and the need to keep everything from the vocabulary we're using to the approach to risk assessment as simple as possible, so that our first line of defense users feel empowered, right, and capable, with some but not enormous amounts of training, to do the type of risk assessment we need, in their function, right? So we're keeping it simple. We're also making it pervasive, so that it may just be once a year in attesting to a policy, or it could be triggered risk assessments based on the continuous monitoring of risk levels against, metric thresholds we've sent to trigger risk assessments. But we're sending those risk assessments closest to where those risks are being taken, triggered on the basis of risk events or metrics that exceed thresholds, perhaps in addition to the scheduled frequency, right? But embedding that risk assessment and making it part of the way our first line of defense does their business, right? And all of that kind of sitting on that integrated data model and the workflow engine, right, that's using business rules to send this information to our people. And then, getting to those predictive insights. So next, we're going to talk about, well, what do we mean by prediction? Okay. Any questions or comments? Okay, because again, I'm going to go back. I'm just going to reiterate the theme we started with, which was, that the technology exists to make this happen, right? We know that. That can't be an excuse anymore. And we can make this scalable and perform at the level we need it to. We know that the data model exists. We've heard groups talk about it on stage. You guys are living and breathing it, right? Performance incentives are being aligned, right, to successful execution of these types of programs, right? Increasingly, we're seeing that. And then also, the smart analytics exist. And then the questions will just be, again, do we have the culture, the level of collaboration we need to make this happen, right? And that, in my mind, is all about the leadership that you guys are bringing in your organization, right? And sometimes it's a little bit of leadership, it's a little bit of counseling that you're doing, perhaps as people have to give up the tools that they once used and join, something that's broader necessarily than the function that they've been operating in historically, okay? So how do we get there, okay? So we've collected this risk data, right? And now what are we going to do with it, right? So one important thing is just data visualization, right? And being able to have that scalable, kind of high performance platform that's in real time able to bring you the information that is important to your role in the organization, as well as, kind of indicate to you what might be most important in terms of your priorities, right? Is it the risk assessment? Is it the assessment of this new event information? Is it the exceptions that are being created by the metrics that may be exceeding their thresholds? Is it the number of open action plans, right, that need to be closed out, right? So we've got a lot of information, but we're using this visualization to help you prioritize, right, based on risk levels, what's most important, right, as you lead this. So visualization, contextual information, prioritization, what's critical, being brought to you, in dynamic dashboards, right? And then, as we move past the dashboarding and reporting, we can say, we've been pretty good in those dashboards at our descriptive analytics, right? We're kind of taking information, now it's real time, right? I think many of you are in organizations where, that came as a result of, the fact that, to get to real time, you went through your period on spreadsheets where it might have taken weeks, right, to get to aggregated information in a dashboard. But now we're here, we have the insight, we have the descriptive analytics, and where are we going to now move into predictive analysis? And then how can we use this information not just to predict, but to gain foresight, into what could be most important from a strategic risk perspective in terms of risk events that are happening outside your company, to help you make better business decisions and give better advice about what the company needs to be doing, right? So, it's about what has happened, what did happen, what is happening. But, we're going to use this risk information to now ask the questions, what is likely to happen, and then what has to be done, right, to mitigate or potentially prevent that if it's a downside risk, or how do we accelerate it if it's a risk that actually brings opportunity to the company, right? So we're talking about mitigation and acceleration depending on which side of the risk we're on, right, as a company. Okay? So very exciting developments in the area of natural language processing. Okay, so this, artificial intelligence, natural language processing, it's almost like another Return of the Jedi, right? We were talking about artificial intelligence, 10, 15 years ago. I think, and the question really became, what do we apply it to, right? I mean, is it just robots we're going to be creating? Is it really just, super genius Watson machines that can beat human chess players, right? There's got to be more to artificial intelligence than that, right? And so now we've had a decade or more to think about these kind of data sciences. And now, building on that data model, building on the wealth of qualitative and quantitative information we're bringing together from inside and outside the company, we're saying, we could be, looking at our information and identifying, as we talked about this major bank in North America, talking about how do we recognize similar issues that may be coming out in different functional groups. So, the vendor risk assessment team may have noticed this issue across several of their vendors around, the importance of, I've talked about this phrase, blue van, right? It may be coming out in our risk assessment in one of our business unit, blue van, and it may be part of some new emerging compliance requirement, blue van, right? But can we use the machine to bring that information, recognize that across the different disciplines and in our data model, so that that information can be brought to the attention and into the dashboard of the risk manager, right? So it's a notion that is being applied today, right? We have customers, for example, that are managing incidents across their company, and these incidents may be, in the first line of defense, where in this case the company is managing, airplanes, right, in large airports around the world, right, and all of the logistics of getting supplies to that airplane, right? Oh my gosh, incidents can happen everywhere. It can happen in the food supply. It can happen in the cleaning. It can happen in the security. It can happen in the plane maintenance. It can happen in, just the personnel managing all these processes, right? So how do they collect information about these incidents, but then use the machine to bring the information, the common themes, recognize phrases, keywords, similarities intelligently. So it may not just be blue van. The guy writing in Spanish is, something about an azul, automobile, right? But the machine recognizing across languages, across functions, where we're seeing something common, right? And bringing that to the intention. And now all of a sudden we have, some type of information that is, possibly able to predict something we may need to look at as a top risk, in the company, because it's emerging as an issue in so many places. Another company using this idea of natural language processing, and even one of our important regulators in the US, collecting information about customer complaints, right? Okay, customer complaints, we're talking potentially thousands of records, right, of information. And as you look at that information, you're not just trying to detect words or phrases that may be the same or similar, but also the sentiment around them. Because some people may be on the telephone complaining. It's my mom, and she's complaining, but she's using very nice language, but she's really angry, right? But then you have another person that may be using expletives and describing the issue they faced, right, from a customer service perspective. But the machine now has to detect that even though someone is being nice, the words they're using, the way those words are being used, they're really quite upset about that issue, right? and then marry that with the guy that's using the expletives as well, right? And so you're seeing something common, even though that issue may be being expressed differently by different people, right? So natural language processing, finding a home in GRC, as we're managing lots of different silos of information and need to bring, that insight to the risk manager who's looking to find the trends across the enterprise and the ideas and threats that may be emerging, for this company. Okay, so that's natural language processing. I've given two very simple examples, but I think you can use your imagination to think, now we've got this large, big unstructured data, we've got quantitative information, we've got additional qualitative information. How is that information going to get related to each other? It's through this kind of notion of artificial intelligence that we're bringing to bear, okay? And then also, thinking about another form of kind of artificial intelligence, calling it algorithmic intelligence. And here another use case is a company that's really based its risk management program on metrics. So very much, kind of an extension of kind of an IT risk framework where you're looking at, metrics around the number of production incidents, the number of asset failures, the number of breaches in our data centers, the number of penetrations in our networks, right? But applying that across the different risk types so that we're thinking about, our people risks, our process risks, our third-party risks in the same way and applying those types of metrics and the thresholds for them. But here, going beyond the idea that a metric has gone beyond a threshold and sending an alert, to do another risk assessment or take some action. Here we're saying, we've got a lot of metrics and we really don't know how they're related. But could we propose some leading and lagging types of results so that, for example, we've had a number of control test failures related to reconciliations in our financial accounts, right? And could this be a leading indicator of write-offs that we're making, in those accounts because of inaccuracies in our financial account booking? Well, hopefully that's not happening very often, right? But the idea is, can we take, groups of metrics and then look for correlations? Because we don't really know. Is it contemporaneously correlated? Is there a leading period? Is there a lagging period? Let the machine figure that out and bring that information to us and say, wow, these control test failures are leading indicators of the incidents that we're having and most of the loss events that we've incurred. Okay? It's not an outlandish notion, right? It makes a lot of sense. But we're now being able to bring this information together, from the very qualitative practice of testing controls, right, to the idea that we're potentially losing money. And then the idea being, well, don't just sit and watch it happen, right? If we know this correlation exists and we see a series of control test failures, everyone should be on alert that a loss is likely. And so if we want to mitigate, maybe that loss will be acceptable, but if we wanted to mitigate that, what might we do? We might invest in the control environment, right, to prevent those control test failures, right, or the failures we're seeing. Any thoughts or questions? But this is now in practice, right? And it requires, a slightly more advanced kind of stage in terms of metrics monitoring. But all we're doing is taking metrics from across the enterprise, whether it's third parties we're managing and the SLAs against their contract, or it's the metrics in our operations, or the metrics, the credit risk metrics, the increase in the loss given default, and how that's related to portfolio write-offs, right? So it's kind of looking across these indicators of market credit, operational, third-party compliance, and other types of risks to find, what kind of information is correlated. And then just to make it more interesting, we shouldn't just look at information inside the company know from credit risk management, from market risk management, we know that external metrics like changes in interest rates or changes in the default rate for automobile loans, those could be related as well to the losses that we're facing in these portfolios, but also potentially volume issues that we're seeing in our operations, right? That we may be measuring just with metrics, but maybe there are leading indicators coming from the macroeconomic environment, right? So it's bringing metrics from inside the company as well as outside, and then correlating these metrics, but then, using those correlations, of course, then it could augment, what type of stress testing should we do? What type of scenario analysis? How sensitive is our capital to the changes in the variables inside the company and outside? Okay, so another form of artificial intelligence, but, again, letting the machine find these correlations and let the machine become smarter about those rules that suggest the relationship between these variables inside and outside the company. So very exciting work, right? And imagine being able to integrate this into that original dashboard we were talking about. And all of a sudden we've gone from a descriptive environment, assessment to a predictive one, right? So we are here, folks, we are here. The day has arrived, right? The Jedi is here, okay? And the question is, do we have, kind of the program execution capabilities, the program management, the culture that's going to allow us to share this information and take advantage of it, ultimately to, feed those better business decisions, right? So we've talked today about the return of enterprise risk management with a force, right? A big force, right? And with a lot of support that we didn't have 15, 20 years ago when we were originally talking about enterprise risk management, as we saw, market credit and operational risk emerge, right? And so we were always wondering, how do we integrate this qualitative and quantitative information? And the exciting thing now is we're able to go beyond the scope. We can understand and how we grow and scale in scope of these data management capabilities. We have a scalable and flexible, adaptable data model. We can identify risk data sources to bring together the taxonomies, and we can mine that risk information to not only describe the environment we're in, but also to predict the types of losses and, most importantly, the types of activities that make most sense given, limited resources within the company, and move away from, ideas around risk assessment just being scheduled to really triggering actions, activities, priorities based on the event information we're seeing in the system. And then, building that reporting structure. So, of course, we have those descriptive dashboards, but also that we're using the machine to intelligently suggest the types of predictions. And when we talk about predictions, we're talking about the types of business advice you're now equipped to provide to that first line of defense user, right? Okay, so questions? Okay, and may the force be with us as we continue on this journey. Some of what we've talked about in terms of, just bringing this information together is aspirational, but just wanted to highlight that, again, just back to the themes, the technology exists, the data model exists, right? The incentives we're seeing at companies are increasingly aligned to getting this done across the first, second, and third line of defense. And now it's just a question, can we execute, and can we bring the culture in our companies that allow that collaboration, right? And see the benefits in terms of the descriptive dashboards and also the predictive analytics that we're going to do. Okay, so it's exciting times, right? And I'm not sure I ever imagined that, when we were originally talking about ERM, we'd be talking about its return. But, exciting for all of us. So any questions that you have? I know it was a late night, right? And I think, Gunjan, everyone's kind of satisfied with the idea that singing, your singing capabilities may be related to the quality of risk management and your ability to execute this program. So that's fine. We can all rest on those singing laurels. But I'm glad everyone had fun. Any questions or thoughts? Challenge? Can we do it? Can we have more case studies next year at this summit where we talk about this in practice? That's our hope. Okay. Well, thank you very much. You guys have a great day.
Good morning again, everybody. We're going to get going here with the next session. I'm sure people will be coming in and out, but we'd like to get going so we can stay on track. I do have a general announcement that I've been asked to give real quickly before we get started, and that is just to remind everybody that the keynote that's going to be coming up at 10:30 is actually going to be in Maryland B. So if you head out this off to the right here, you will go down the hallway to your right. That's where you'll find the Maryland set of rooms. Okay, the next session, let me make a quick introduction. Tom Harper from the Federal Home Loan Bank of Chicago will be making a presentation on a case study about what they've been doing in GRC and about their program. I am Kurt Reindl with our professional services group. I have been working with Tom and the Federal Home Loan Bank team now for 4 years. Or basically since I joined MetricStream. So it's my privilege to have Tom here and to make a presentation. Tom is the Executive Vice President and General Auditor for the Federal Home Loan Bank of Chicago. Prior to joining the bank as Audit Director in June 2005, he worked for J.P. Morgan Chase. Tom was in charge of the team supporting capital markets and international treasury services, commercial and corporate areas, and investment banking. Prior to coming to Chicago, he was a manager on the international audit team based in the UK. Tom is a chartered accountant, certified information systems auditor, certified internal auditor, and a certified financial services auditor. He is a graduate of the Imperial College of Science and Technology in London, and it's my absolute pleasure to introduce Tom Harper to the stage.
Thanks, Kurt. So let's see if we made this work. Thank you very much for inviting me here. It's a real pleasure to meet with all of you and with my colleagues from MetricStream. As Kurt alluded to and you heard, I'm not actually from Chicago. But I hope I've got an illuminating story to tell you. It's taken a number of years to create this story, and I think it's got some lessons learned in it for everybody, both about overall project management and how you institutionalize something like this, and also about GRC projects in general. Some areas of focus, why it's been so important to us, why it's worked for us, what we see the real value is, some insights into why individuals and understanding how individuals operate within the program is important, how we thought about and designed ours and what we think made it successful, and really how to make it part of the organic organization. Just briefly, the Federal Home Loan Bank system, we're actually a cousin of two other more famous GSEs called Fannie and Freddie. At one point we used to actually own Freddie Mac. But now the 11 Federal Home Loan Banks, which are separate entities, they're a bit like the Federal Reserve Banks. The districts are different. Don't ask me why the districts are different. But they support housing finance and the banking system in general across the United States. Their membership, their customers, and also their stockholders are credit unions, insurance companies, community banks, community development financial institutions, and state housing authorities, and they provide liquidity and funding for all of their activities. And in fact, in the crisis of 2008, the Federal Home Loan Banks, without doing any special policy changes, injected several $1 trillion into the financial system long before the Federal Reserve started to react to that demand for cash. In Chicago, we're a $70 billion bank. We support over 700 members in our districts. which is the states of Illinois and Wisconsin, so we're quite a small geographical area, providing them with very low-cost funding, basically at the same rate the federal government funds at, although we're not guaranteed debt by the federal government. We also purchase mortgages and provide liquidity for members by purchasing mortgages. And we also provide a important, and indeed I think the largest private funder of affordable housing in the country. So we all like not paying tax. Well, the federal home loan banks don't pay tax, but they do spend a proportion of their income has to go in mandated affordable housing programs. That leaves us with an interesting paradigm because we're a large regulated financial institution, but at the moment we're about 425 personnel in our facility in Chicago. So we're not a large organization by people size. So a little bit of the context of this, and those of you in financial services will recognize all that this is going on. The regulatory expectation over the last few years has just gone up dramatically. I'm sure you've heard about that in the last few days. It's provided a particular challenge to audit and risk committees. It really has driven an expectation of the board in particular, and then the board has driven that down onto management to provide them with information and provide them with insights into how the organization is governed. And indeed, that's had to even more be demonstrated to those regulators how we do that. And what we've tried to engender in the Home Loan Bank over the past, I guess this story takes about 12 years to evolve, certainly since I joined the bank. We've tried to see risk management and governance and compliance as an organic part of our organization that actually allows us to succeed. What we're trying to do, sometimes we succeed better than others, is not see it as just an overhead that we've got to deal with because there's a regulator knocking at the door, but something that actually enables us to operate more effectively, sometimes because we can respond to that regulator more effectively, but that really allows us to develop and bring our organization forward at a pace that allows us to serve our stakeholders and our shareholders better. This was some research that showed that in US banks anyway, the organizations that had nimble and effective risk management organizations and compliance organizations tend to have a much greater return on capital. And that allows them to perform that much better. So as you think about this, there is now, certainly when we started, there wasn't this sort of research, but there is now substantive research that if you're good at this, it has a positive benefit to your stakeholders. It's not just a compliance exercise. So back to the story. The genesis and the challenges of where we went, some of the strategies we used to develop them, quick insight into what our environment looks like, some of what we've accomplished, and some of where we're going at the moment with the overall strategy. Where we came from, I alluded to this earlier, and this is back in 2005, 2006. We had enormous regulatory pressure. We had slipped up, you might say, in a big way. Our regulatory reports were getting thicker and thicker, which is never a good thing. You want really thin regulatory reports. And the regulator was becoming increasingly concerned about how we governed the bank, how we risk managed it. And at the same time, we were trying to do some other little clever things like registering with the SEC, which the regulator had insisted on, which meant Sarbanes-Oxley was coming on top of us. And the immediate reaction of the organization was to hire a lot of people and to create a lot of spreadsheets and create an enormous amount of overhead. And as we did that, we were trying to change products because the regulator was pushing for changes in our product dimensions and how we organize that. We had interesting relationships with our stakeholders as we decided to withhold a dividend and other things like that. Our directors were getting very concerned, not unnaturally. Ultimately, that would end up in a cease and desist order and various other little interesting regulatory artifacts. And overall, the overhead of the business was accelerating beyond our ability to make money in a relatively low margin business. So where we went with that is, and I don't even know that we'd heard of the words GRC, but we went down a path of trying to consolidate and integrate as much as we could. We had to really provide a much more transparent reporting framework to our board. Our board was getting bombarded with reports from various different organizations within the organization, whether it was the legal group, the compliance group, the audit group, the risk management group, the SOX controls group, and they were all giving them different lists of outstanding issues and outstanding controls and how we were managing it and what was working and what was not working, and the board was thoroughly confused. So we're really trying to provide a lot greater level of transparency for our board and our executives. We also had managed to generate a culture at which people were just interested in complying with whatever the regulators said or whatever management said and not thinking about it and what it meant for us and what it meant for our business. And we really felt a need for people to step back and take accountability for what was going on. And lastly, in doing all of that, we hoped to dramatically reduce our costs and our overhead. And it's not just hard dollar costs, but the soft dollar costs of managers turning around every day and looking at their email and going, oh God, I got another spreadsheet I've got to fill in for another oversight unit. So how do we do this? Well, the key, frankly, was never miss a good crisis at this point. We had really strong buy-in from a CEO, from a chief financial officer. Surprisingly enough, the chief audit executive was quite happy about it. The chief risk officer and our business leaders were all highly bought into, we need to do something different. And we need to do it fairly quickly and declare success around some core objectives. We looked at a number of different frameworks and ways we could do this, things that were important to us. We prioritized where we needed to go. So early quick hit was issues management, for example. But generally to get to one model for most things. And we didn't try, we thought, to take on too much too quickly. So we knew what our short-term goals were, and we had a long-term vision, and that vision, certainly even today, continues to evolve. Challengingly, we managed to sell everybody a conceptual framework. We said, we don't actually understand all the details of how this is going to work, but here's the big idea. And we brought everybody into the fold. And, you know, it really helps having a C-suite that's on board. And when people are like, well, that doesn't work for me, they're kind of like, well, you've got to work out how it's going to work for you, because it's going to work one way or another. So we were really able to bring people into the fold and the strategy. Like I say, tactically, we brought our issues management process together first, and we were able to declare success, and the board was able to put its thumbs up and say, this is fantastic. I've just got one spreadsheet that tells me what the outstanding issues in the organization are and how they're prioritized and when you're going to get them fixed. And that, just doing that was a huge success and enabled us to really vindicate the process. We managed to bring other stakeholders in. So I was a stakeholder as an audit executive, but we managed to work very closely with our risk management people, with the people who were managing our financial controls infrastructure to really move to a single view of what it might look like. At the same time, we were trying to knock off a couple of tactical things. We just wanted less spreadsheets. If we had less spreadsheets, we believe we'd be in a better place. And I mean governance and risk type spreadsheets specifically, though we could talk about others. We wanted to deliver transparency, so every time we could simplify a report or collapse 5 PowerPoints into one PowerPoint, we thought that was a positive thing. And we were really pushing for some integrity in that reporting. What we had found is, as we had multiple reporting frameworks, multiple reporting processes, there was a lack of integrity, which then destroyed the credibility of the information you're reporting to management. If the board could look at 2 reports in their board packet and say, well, this doesn't make sense. You've got 72 issues on this one and 71 on this one. What's the difference? And you go, oh, it's a timing difference and apples and oranges. It really isn't a helpful thing to be talking to your leadership about. So I talked about how we brought everybody together. We really had that entire C-suite working together. We had the major business organizations working together. The second and third lines of defense all integrated. And to a greater or lesser extent, we brought in the regulator and the external audit partners. Though, as we've evolved this, they have become a secondary stakeholder, if you like, not a directly integrated part of the process. So, talked a little bit about it. What were we trying to do? Well, after getting that issues management into one place, the other things we really worked on were bringing the business units and the business risks and the controls all into one core central repository. We brought all the key oversight groups that manage those things, like our operational risk management group. FIG is our financial reporting risk management group. Our compliance function and internal audit, who in our organization is the only people who actually have to go out and validate that any of this works, or certainly at this point it was, into one so that we were talking about one universe of objectives. And we tried to bring in all of these different components of the overall governance environment, regulatory reporting. Where's it done in the organization? How does it tie in? What are the controls around all the different processes we have going on? What regulations are we trying to comply with? What operational risks are we trying to manage? And then we tried to identify a set of risks we were going to manage. And we started with a very top-down approach. We had, I think in the organization, I counted at one point 6 different risk models, depending on how you were going to cut the cake and which organization. Technology risk had their own risk model. Operational risk had their own risk. Our enterprise risk management had their own. Our financial people had a different one. Compliance had a different one. And then audit probably had another one. We consolidated around a set of risks, and we said, this is it. Whatever we do in our organization, it has to fit into this list. Caused a lot of heartache up front, but actually it survived 12 years. It's still the same set of list of risks, and everything seems to fit into it somewhere. and the ability to be consistent has really shown up. So what do? We bring together the compliance program. We have a process for sucking in new regulations. We have a process for identifying and adapting our SOX controls. We've now had to integrate a new set of prudential standards into that. So that's one big input into our risk framework. We've integrated our management risk assessment, and when we started doing this, that was really an annual process and a significant overhead in and of itself. It's now an organic process, much more. We reevaluate both in internal audit and the management organization, our risk assessments continuously now. We used to have to do a whole separate set of fraud risk reporting, because one of our regulators asked for that. That's now been integrated. We had a similar thing which we had to do for money laundering. It's been integrated into the process. Event reporting, technology incidents, and how we manage the change management within the environment. And these are now all pretty much business as usual. We don't even think about it. If somebody walks in the door tomorrow and asks for a fraud risk assessment, it won't actually be a big deal, and we'll give them the fraud risk assessment as of the night before. It isn't 6 months old, it's as of the night before, because that's when it was last updated. Now, that maybe it's the same as 6 months before, but it is constantly being updated. And then we integrated independent reviews as well. So, and this was another big area where we lacked consistency. So certainly those of you who are in the financial services space, you probably have model validation teams and compliance functions and people coming in doing SOC 1 reviews, people who are doing independent reviews, consultants coming in doing reviews on behalf of the business, penetration tests on your technology stuff. We've brought all of that information together into a central place, so it's integrated in. It has a standardized way of reporting. We identify every time there's an issue in one of those reports which of our control elements are being impacted, and we can all think about it in a very consistent way. So what has this really meant for everybody? I guess there's a common theme in the word integrated. It's very integrated, but there's also, if you look at this picture, an awful lot of those little stickmen people. A lot of this is not about the technology, but it's about the people and making sure that they are educated, have bought into, it's part of their lives. So, there's a blob up in the top right-hand corner that says metric stream, but the big important thing is everybody is using the same data set. They talk to the same people about the same language when they're thinking about these things. And we have either the data is actually uniquely within that integrated infrastructure, so that infrastructure holds our risk and control library, or it's integrated into it through some sort of interface. For instance, our general ledger account structure and chart of accounts is not held in there, it's held in the general ledger, but there's a periodic resynchronization process, and every general ledger account is cross-referenced into that library, as are all our vendors and all our assets and other attributes, as our frameworks to the extent that we use them, and all of those things. It's not all done perfectly. It's not all done through the technology. There's still the odd manual spreadsheet. There still is some human intervention to make it all work properly. So this is more trying to describe what our actual environment looks like. And certainly this is how we started it off. We talk about our business as 5 main core business products, and these aren't organizational products. These are business processes. These are the things that we face the outside world with. And those are the vertical silos here. This is where we lend money to people. This is where we buy mortgages from people. This is that community investment activity that I mentioned earlier, where we're funding affordable housing across the country. And then the other side of that equation, if you like, if you're an accountant, is we have to get money from somewhere. So we issue an awful lot of debt on the world capital markets, and somehow we have to balance the interest rate risks between the money we lend out and the money we bring in. Those are the ways we face off against the outside world. That is not an organizational construct. And we think that's very important. So it doesn't matter when we reorganize the bank or we change our org chart. This idea has remained incredibly static over the last 12 years with relatively little tweaking. We've been able to maintain that stability, which also means we're not making masses of changes, which also means we have continuity between periods. We understand the risk assessment as we do, for instance, a risk assessment. We know how it aligns with these products. And it's been an interesting thing for those people, those business people, to understand how they might be accountable for one of these silos, but they aren't actually in control of it all. So each one of those silos will include operational aspects, it will include delivery aspects, it will include whatever the relevant compliance aspects are, it will include the settlement activities and things that go on within that process. In the horizontals, you see how we then look at our organization horizontally, and we identify a number of areas which are really not outward facing, such as our financial management, such as our overall governance and strategy at our executive level, how we run technology and operations, how we do certain administrative things like internal audit that cross all areas of the business, things like our market risk management capacity. Again, remarkably consistent. Believe me, like most organizations, we've been through multiple personnel changes and restructurings and rebalancing. This organization has survived all of that. And certainly in my history, before we went down this path, I used to spend every year half the nightmare of creating an audit plan or a risk assessment every year was somebody'd rejigged the whole organization in the last 12 months, and I had to rebalance the whole thing and explain it to people that apples were oranges and how it didn't go together. This idea has managed to eliminate 90% of that frustration. And we literally are recalibrating it every year as things change, or maybe a new regulation comes in, or we re-emphasize parts of our business. And that's really allowed us then to collaborate and explain much more consistently to all our key stakeholders and understand much better how things fit together organically. Event management is a classic example of where we can do that now. Instead of thinking about, did the ABC unit make a mistake or get something wrong, we're thinking about how does that impact a whole business process. They may think it's very, very important, but maybe it isn't in the bigger scheme of things. And on the contrary, they may see it as relatively unimportant, but actually the downstream consequence within their business process might be much greater, and we can actually see how those things integrate and come together. We can do the same thing when we do financial reporting and you're doing key control assessments. I will admit every so often a control goes wrong. It doesn't always work, and we have to have a long conversation with our public accountants about what the impact of that is and where the compensating controls are. Well, because all the controls are aligned down these business lines and are aligned with the general ledger, we can rapidly demonstrate where the compensating controls are that are relevant to that area. We can also demonstrate where there aren't any compensating controls, which is a much more interesting conversation to have. And for my team, it's made them, I think, much better performing because they have a much better view of what the organization is and what the processes are and what the risks are that they're trying to evaluate. They're no longer looking at a single business unit as defined by a human resources org chart. They're looking at a business process and what the risks are within that business process, and are relatively, totally, hopefully, indifferent to what the organization is that's underneath that. So, what are some of the things that have been the outcomes? We think there's been significant benefit to it. It's frankly probably harder to see today than it was then, because now this is part of our DNA. So many of the people we talk to don't even remember how terrible it was before. But we have a consistent way of evaluating risk. It's highly consistent. It's becoming more consistent. It's now consistent at the level at which we use the same risk assessment model, whether you're in enterprise risk management, operational risk management, business continuity, even maybe technology, if you're doing model evaluations. All of those areas are basically using the same risk model and the same language to talk about risk and what their priorities are, which is just a subset of the overall idea that we've got a very consistent way of talking about business processes and talking about risks and what we're managing. We have very consistent risk reporting now. It's not that we don't debate it or that it's always identical, but we no longer spend much of our time explaining why there are differences in reports that are artifacts of the way the reports are structured or the model that's underlying them. We're talking about what are the real differences in opinion or metric that we're measuring because we measured it differently. We're able to look at things over a time frame. We're able to measure how things change over an extended period of time. We're able to look at the changes in our risk framework and control statistics, and understand how that's impacting our organization. What we have seen, certainly in this short period, and I apologize for the artifacts of PowerPoint conversions, I guess, but the risk, the way that our these bottom charts show the number of issues we were tracking over like a 2-year period. Over a 2-year period, we saw as we started to track stuff consistently, provide the metrics to people, we just saw, the low-hanging fruit getting knocked off a lot more quickly, and people being able to focus on what was important and get things resolved. Cost wasn't our top priority, but it's always an important priority. As we implemented this framework early on, we saw a significant reduction in headcount. Some areas just stayed flat, other areas came down dramatically. Probably the biggest winners and losers, financial report, we basically eliminated our SOX risk management department. It came down to one person by the time we'd finished with this, because that's all it really took to run the logistics from a financial reporting perspective. So we continue to have an end user computing aspect of this. It's mostly in the interfaces and how we get data in, how we manage our data. We're trying to eliminate that. We really have implemented now pretty much an evergreen risk management program. Our operational risk people are refreshing it on a rolling basis by business unit. In internal audit, we're probably a step ahead of that. We actually refresh the entire risk assessment every couple of months. We've integrated an element of continuous monitoring and continuous control evaluation into the process. We continue to try and do that. That's a real core objective. And the nice thing about that is we now have several business leaders who basically, if there's a new process, a new compliance aspect, and believe me, we have new regulations all the time, the first thing I said in the meetings, they ask their staff is, how are you going to get this into the framework and get it into the system? I'm not interested in you generating another Excel spreadsheet and showing me how this works. I just want it automated because I know you can do that. And overall, this process is becoming less part of the second and third line of defense and much more part of the first line of defense, and how we actually manage operational risk and compliance risk as we move forward day to day in the business areas. So it's not all perfect. It certainly cost a non-trivial amount to maintain this infrastructure. We think it's significantly less than the overhead it would be if we ran it all on the back of an Excel spreadsheet. As one example, this is actually our third technology iteration in this evolution, which was really as necessity occurred, as the idea was more and more successful, we outstripped the technology and needed to implement better technology to make it work. But the idea has been consistent right the way through this process. All business units have to participate. There is a real human aspect to this. You have to bring people along. That can be challenging. That may mean you have to kind of find a circle of friends and eventually show how successful it is, and other people will join the club. That's certainly a strategy we have used occasionally. There is a level of overhead. I would argue it's certainly no worse than the overhead you're going to suffer anyway in the current compliance environment. And you know, on the upside, that integration has a real positive to it. You generate a lot of documentation. I'm not a huge fan of documentation, but in the current regulatory environment, if it isn't written down, it just doesn't count. Whether it's my external auditors and the PCAOB who's on their back, or my federal regulators, if I can't demonstrate it on paper, then or a PDF file, they really it just doesn't work. So being able to have everything in a consistent and coordinated documented place has a real benefit for the organization. So where are we going? We're in the process of integrating some of the other things that go on that are really important in the organization, and certainly flavor of the month. Business continuity is actually planned, is probably pessimistic. It's in process at the moment. So our business continuity colleagues have basically just adopted the framework, said whatever we're doing before, yeah, we'll try and leverage that. But we're just going to suck up the organization and the framework that is in place for the rest of the organization, and we're going to suck up their risk assessment model and really integrate those together. Vendor risk management is now using a very similar model, and we've integrated their data into the overall framework. Model risk management, which is like a separate validation group within our organization and certainly many financial services companies, just adopted the whole framework out of the gate. They had nothing, so it was a relatively easy place to go to something, and we literally just cloned what we actually do in internal audit, and they use that out of the box to make that work for them. And then what we're doing, have done, continue to improve is really to integrate all of the data in the organization, be it from applications, locations, end user computing, into the model so that we better understand the integration between all of these things. You know, an interesting thing we're doing at the moment is we just created, you'd think this was fairly straightforward, but we just created an inventory of all our regulatory reporting, which is just a little bit scary. And then we're bouncing that up against our list of applications and end user computing to see where it comes from. And we figure we're going to find some gaps in that process, either spreadsheets we didn't know about or reporting we didn't know about one way or another. And I showed that very simplistic diagram of 5 products and however many horizontal layers. We've developed that a bit. We've taken that down another layer. So we found, you know, within each product, a handful of sort of sub-dimensions. And we've started to get a little bit more granular about those things. And interestingly, that was probably mostly driven by things like business continuity management, because within a product, not every sub-product is as important as every other one. So that was very much a derivative of some of that work. Likewise, it increased the complexity by an order of magnitude the moment we started to do that. So there's definitely a payoff equation as we work through some of that stuff. And we continue to try to get things more integrated. So finally, why does it all matter? Well, I talked about cost savings. I talked about the confidence of the board. There's also a real element of confidence in executive management. We know what we know, and we're not surprised very often by things. We're able to demonstrate to our regulators we have an exceptionally burdensome process whenever we want to do anything. And believe me, most of what we can do is governed by act of Congress. So you know how fast Congress moves. Trying to do something new is a little bit of a challenge. Every time we do want to do something new, the fact that we can demonstrate where the controls are, how we manage that, we can demonstrate that we have managed similar risks in the past, allows us, we believe, to move forward much, much faster on those things. Albeit we've still got the bureaucracy to deal with, but even they are more confident that we're confident that we know what we're doing as a result. We know what we do well, we know what's replicable, we tend not to reinvent the wheel if we've already got a process in place. We started off way back when, I think at one point we had like 400 key controls in the organization. Now that might have just been key SOX controls. We whittled that down to about 60 over a couple of years, because we found that actually most of them were just variations on what somebody else was doing, or they were something that somebody did, but they weren't really key. But having that centralized repository allowed the CFO and some other people to sit in a room and go through that inventory and go, okay, we're just going to have one control design for, I don't know, I'll pick on something, doing a reconciliation or balancing or something, and leverage that multiple times rather than having every flavor of it across the organization. And that allows us, when we want to do something new, we have a model, and we're really focused on what the newness is, not reinventing the wheel about all the things we really know how to do already. And because of those constraints, certainly most things we do are a flavor of what we were already doing. So that really kind of wraps up where I was going. Hopefully I've given you some idea of what the benefits are of integrating all of this stuff together, what some of the key strategies we use to make it happen, why we think it's worked, and somewhat where we think we're going with that story. So with that, thank you. Any questions?
So all the risk management application you have implemented the same time, or you have started one by one?
Say that again.
All the risk assessment, like for your regulatory, for your antibody or credit or finance, whatever the list you have you implemented all the applications the same time, or
No.
you started one by one, or
Absolutely not.
what's the approach you have used?
Right. We started with a model that was really, I think we really started with the audit risk assessment, and then our enterprise risk management group said, oh, that's neat, that works. We're going to do that. So then it became both our risk assessments. And then, you know, as other groups have come along, we've pushed, cajoled, persuaded that that's really the model that everybody should use. So, no, we started somewhere, demonstrated success, and then pushed it out. Does that mean we've had to tweak it? Absolutely, we've had to adjust it, but it's mostly been refinement rather than anything else.
Okay, we could probably take maybe one or two more questions because I want to get you all off to the other session at 10:30.
On the downside slide, there was a reference about the level of administration of the program. Could you share what is the structure, what are the responsibilities, and how many people have this role of administration of the program?
Sure. We survived for, best part of 11 years without having anybody formally dedicated to the product, so it was a shared responsibility. Some people might have spent more time on it than others. And actually, our current leader is at the back of the room in there, and he now is our sole body who is full-time responsible for the product. So we finally got to the point, and it's mostly because of bringing in all those different groups that I was talking about, that there's enough maintenance work and supervision required to do that. So before that, we were, frankly, it was somebody's part-time job, and that worked. When we originally implemented both MetricStream and its predecessor, I think one of my staff worked on it for 3 months flat out, dedicated, but that was a kind of one-off. Then you go back to your normal day job type exercise. So it's got an overhead, but it's not huge. And when I think about having one person spread across our organization, I think that's a pretty reasonable payoff within the equation. Okay, any last questions?
Great, Tom, thank you so much for your time
You're
and
welcome. Thank you.
presentation. Just as a reminder again, the keynote is actually in Maryland B, so it's not in this room. So go down the hallway to your right past the registration. That's where the Maryland rooms are. It'll be in Maryland B.